Welcome to the Fitch Ratings Fixed Interest podcast. My name is David Prowse. Every quarter, Fitch Ratings publishes the Risk Headquarters report, where we outline our views on the key risks to global credit. And today I'm speaking to the author of that report and frequent Fixed Interests host, Justin Patrie, who is the head of Fitch's credit commentary and research team. So Justin, there's certainly a lot going on in the world right now. Given this, how has the credit risk environment evolved since the start of the year?
Thank you very much, David. Yeah, so the short answer is that the risk environment has deteriorated. The global economic outlook has worsened, and the policy environment, especially in the US, has generated a significant amount of uncertainty where the potential outcomes are much wider than previously supposed. If we go back to the beginning of the year, we started the year with a broadly neutral outlook for global credit. Our 2025 macroeconomic forecasts had a deceleration in global growth, but not a material decline. And the vast majority of the 2025 sector outlooks we made, so the sector outlooks are, over 200 regional and global corporate, financial institution, and other issuer sectors, and asset performance outlooks for structured finance. All of those, or the vast majority of those outlooks, were neutral. So overall, our base case for global credit was broadly balanced. But that base case was also characterized by an elevated level of uncertainty and risk, most notably from the incoming Trump administration, which had campaigned on a wide range of policy initiatives, some potentially positive for credit, but some potentially quite negative. And among those negative policies, which our forecasts and outlooks were predicated on, were for U.S. tariffs to materially rise, including being levied on major friendly trading partners. At the same time, the global economy is, broadly speaking, in the down phase of its cycle, feeling the effects of elevated interest rates. So that's not usually kind of the best place to be in terms of risk. But since then, what we've seen is that the level and scope of tariffs that the Trump administration is willing to consider is much higher and broader than the market had priced in. Generally, with regard China, it's probably been on course for what was expected, but especially with regard Canada and Mexico, two of the largest U.S. trading partners, this has been trending toward much higher and much more broadly applied tariffs than was anticipated. Trump has also repeatedly paused or offered exemptions in certain areas, and that has added to volatility as well. So the trend has certainly been toward a major trade war with the U.S.'s largest trading partners, and that materially worsens the broader, macro credit view, and the cross-sector credit view as well. It's important to highlight that the uncertainty is also a key factor here, and that so the outlook going forward is that we need to consider sort of a wider range of policy options that the Trump administration is willing to consider.
You obviously mentioned tariffs and policy uncertainty, and there's a lot of news flow around these subjects. But more broadly in this environment, what actually matters for credit profiles and ratings, and what doesn't actually matter?
Yeah, so each issuer rating is fundamentally a bottom-up assessment of an issuer's ability to meet their financial commitments. And they are assessed on a through-the-cycle basis, meaning that the ratings should actually be quite robust through the deceleratory and acceleratory phase of the economic and credit cycle. So for the most part, ratings are issuer by issuer, and it actually takes quite a lot to move credit fundamentals on a large scale across, hundreds or thousands of issuers. And we've got a lot of great, charts and research that are available on our website that kind of shows, when you see some major moves in ratings, and it usually takes a, major systemic crisis. That all said, the macroeconomic outlook matters, policy and regulation matter, secular changes, from technology or behavioral changes or whatever matters, and the funding and liquidity environment matters too. And over the past few months, I would say, if you're trying to, break through a lot of the noise, the things that we're trying to look at is those issues that matter for global credit are going to be the ones that affect those kind of bigger picture issues. So U.S. policy right now is obviously a big issue. We've started our conversation talking about that, and there are half a dozen or so kind of policy areas that we continue to focus on in this area. So tariffs, as I've mentioned, taxation. We have a big budget bill looming. Tax cuts in the first Trump term were definitely a positive for cash flows for U.S. corporate issuers, and this could be a major tailwind for corporate credit in the United States. Federal program funding, regulation, foreign policy, immigration. These are kind of the policy areas that we believe will matter and are things that we're looking at. But beyond the policy initiatives, I think focusing on what that means for the economic growth outlook, for inflation, and then by extension, the outlook for interest rates and funding and liquidity are also the things that we're looking at.
Can you speak a bit more about the Trump administration? It's been a very active first 100 days. Have Fitch's views on the implications of the election outcome evolved, and where there have been surprises leading us to reassess our views?
Yeah, so prior to the election last year, as far back as I think July, we published reports where we clearly outlined our views on where we saw likely major shifts in policy under Trump administration, and those kind of policy themes that we highlighted, those still mostly apply. Certainly, it's not a surprise to us that the administration has instituted higher tariffs, has rolled back climate policies, is tightening immigration, is signaling tax cuts. I think that's something that's still to come. Is generally has a much more deregulatory orientation that is cutting and reforming certain federal program funding, and is also shifting foreign policy away from kind of more multilateral and international institution support that we saw under the prior administration. I think where there have been some reassessments in our views is I'm going to go back to tariffs again. I think that we are updating our tariff assumptions and the implications of what that means for economic growth across different countries. I think some of the cuts to program funding have been larger, I think, but I would suggest that that's still a wait and see, as we don't have a final budget yet. So I think the upcoming Congress's first budget and what ultimately gets approved, that's going to be very, very important. On the foreign policy front, I think there have been some surprises. For example, the Trump administration's approach towards Canada, Greenland, and Panama. Those countries were not, really mentioned that much on if at all on the campaign trail, and that could lead to material policy changes in those countries. So that's also an area of surprise.
You mentioned the inflation and rates outlook potentially changing as a result of higher tariffs, and we've seen a lot of market volatility so far in the first quarter. In the US, equities are sold off and bond yields are down, whereas in Europe, bond yields are up and stocks have outperformed. How does all this affect global credit?
Yeah, so interest rates, the cost of borrowing, access to capital, all of that definitely matters for credit. If you take a random sampling of our sector outlook reports for 2025, those big picture outlook reports, you're going to find multiple references to loosening financial conditions as a supportive factor this year for that sector's issuers. Essentially, rates are going to be cut in the U.S. and Europe, and that's positive for a lot of sectors. So what we're looking out for is whether economic conditions, investor risk appetite, monetary policy, those sorts of things, whether that has shifted, and whether it's shifting the outlook for the broader funding and liquidity conditions towards a tighter or looser environment. In the US, as you've said, treasury yields have fallen, but high yield credit spreads have widened a bit, suggesting a more risk off environment that could make it harder for certain issuers to borrow capital. In Europe, government bond yields have spiked, but equities have also risen, reflecting an expectation for much more expansionary fiscal policy. So it's that's a bit of mixed signals, and I think a lot of that is kind of predicated on the uncertainty around the policy environment right now, which kind of makes it quite difficult to determine where markets are going to kind of trend for the rest of the year. I will say, on the positive side, if over the next few months we see some major settlements on key issues like trade, geopolitical risk, taxation, fiscal policy, then once again, I think you could see some major shifts again in the general trajectory for the market environment towards something that would be more accommodative to credit issuers. But right now, I think volatility is quite high until some of those major issues are settled.
The Risk Headquarters report is, of course, all about risk. If you could narrow down the one big risk that matters most over the next 3 to 6 months, what would it be?
Yeah, so I don't know if Fitch has a house view, but my personal analytical view is it's not a really a creative answer, but it's a global trade war. I think that's clearly the risk that I think is most imminent and present right now. And the thing that I would say is if you look at history and trading relationships between countries, trade wars can be very emotional. They can be very blunt as opposed to surgical. And the risks that a trade war escalates out of control, changes the growth and inflation outlook across multiple major economies, causes a market correction, upends relationships that have been built over decades. I think that's a risk scenario that I would be kind of most concerned about.
And finally, when will the next Risk Headquarters be published and where can listeners find it?
The risk headquarters report. It's a quarterly report, and the second quarter edition is going to be out next month in April. And I would just say the risk headquarters report is also always freely available at fitchratings.com.
Thank you very much, Justin. And as always, thank you very much to our listeners. If you would like to learn more about Fitch's credit ratings and analysis and to read the latest quarterly Risk Headquarters report, please visit our website at fitchratings.com.